Welcome to the EP Wealth Advisors Informed Investor Market Update. This is a special edition. We are recording on August 19th, but we will be talking about gold and the dollar today. And here with me, as always, is our Director of Portfolio Strategy, Adam Phillips. He's a chartered financial analyst, a certified financial planner. He's a voting member on our investment committee, and you may have seen his commentary in the Wall Street Journal, Market Watch, Bloomberg, CNN, Cheddar. And we're excited to talk a little bit today about the implications of gold and the dollar. So, Adam, thank you as always for joining us. Let's start with the dollar, right? There's been a decline in value. Can you give us a little bit of backdrop as why and what this means?
Sure, Breene. So yeah, through today, the dollar, what we refer to as the spot index for the dollar, is down about 10% or so from the March level, from the March high. And so we've seen a pretty dramatic drop in the dollar, and I think a few things are driving it, but certainly the main themes that we're looking at are the rising level of debt in the U.S., the growing deficit in the U.S. that is sending a lot of flows outside of the U.S., as well as the fact that many economies overseas are really handling the coronavirus better to date. And so you've seen that in prior years, the U.S. Was referred to as the best house in a crummy neighborhood during the financial crisis. It's not necessarily the case right now. We're certainly still the strongest economy, I would say, but we've handled the coronavirus maybe not quite as well as some of the other countries out there. And I think that's reflected in the recent decline in our currency.
So like, what does that mean for how does the dollar affect the markets, right? Like, can you talk about the implications, as you get into the investments?
Sure. So really, when you're investing in overseas stock, for interest, you are not investing in just that company. You are investing in the currency in which that stock is domiciled. And so if you're investing in, say, a Japanese company, you are taking a play, whether you know it or not. You're making a play on the Japanese yen. And so that is how your investments are really impacted by currency moves. And so it's something that we certainly consider when we're allocating portfolios and managing our strategies, is how much of an allocation to foreign currencies do we want to have, because ultimately that does play a role in the returns that you're getting. So right now we have an overweight to things like large cap stocks, and we certainly have an allocation to foreign stocks. About 25% of our stock exposure is allocated outside of the US. So that is our way of playing and benefiting from a declining dollar. And some people might think, well, if you have an overweight to large cap stocks, maybe how does that actually benefit from a declining dollar? And really the answer is that a lot of these companies are generating the majority of their revenues from overseas. They're actually multinational companies, these companies that we associate with every day. And so they really do move based on currencies. Think of a company like Nike that does so much of its sales overseas. And so that is a way that we can indirectly make a play on currencies within portfolios.
Okay. So as you talk about the decline in the dollar and what that means, it sounds like there's a degree of concern there that is driving that decline, right? And then getting into our second topic, gold, can you talk to me about how these two are interrelated and what it means for the recent price spike in gold?
Yeah, it's really interesting. Normally what you would see historically is that both gold and the dollar are seen as safe haven assets. So when there's fear in the overall markets around the economy, you see the dollar do well, as we saw during that March phase when the dollar kind of peaked and gold started to move higher. And so these two typically move in the same direction because they're both considered safe haven assets. What we've seen in recent months is that the dollar has actually fallen while gold has gone up, and it's actually around its record level. It's over 2,000 if you look at the spot index for gold. So we have seen a little bit of a disconnect there. What's happening with gold is a little bit different. It's kind of the perfect storm, Breene, for gold. And historically, I think that the big knock on gold has been the fact that it's not a stock and it's not a bond. You're not investing in getting a portion of earnings. You're not getting any income from it. The beauty of gold is really in the eye of the beholder. And so it's very hard to determine a fair value for gold because of that, because there's no cash flows. And so I think the reason that one of the things that's driving gold is we can talk about a lot of drivers. I think chief among them is probably the fears around inflation, with so much money being essentially printed or injected into the system around the world, and fears that might ultimately lead to some inflationary pressures. I think the other thing, though, is that when this has essentially in the past provided no yield, that's been a huge drawback, because why invest in gold when it's not providing income, when you can invest in, say, a treasury bill that has, or a treasury bond that has just as much safety, if not more, but also provides you with some income. Well, looking at the current environment, treasury yields are extremely low, and they're actually negative if you account for inflation. It's what we refer to as having a negative real yield, real meaning after inflation. And so all of a sudden, an asset like gold that doesn't provide any yield doesn't look so bad. And so that is what's really driving the price of gold right now. And so I just consider it really the perfect storm in that case.
Okay, but what about going forward with gold, right? Like is this something that investors should be considering? Like, what part of the portfolio should it be playing? Like where are we going?
I think that's a really good question, Breene, because I mentioned it's the perfect storm. The price of gold has just shot right up. It's through 2,000 now. It's at a record level. So where do we go from here? And what I would say is that, kind of going back to what I mentioned, that the price of gold is in the beauty's in the eye of the beholder, and really what we've seen driving a lot of the flows have been retail investors. If you look at those ETFs or exchange traded funds that have received the most inflows from investors over the past few months, gold is at the top of that list, meaning that it is, one can argue, it's extremely crowded. And what that means is that it's subject to potential swings. If all of a sudden investors decide that it's not quite as appealing as it once was, you could see that those flows exit. And you got a little bit of a taste of that a couple weeks ago when the price of gold dropped almost 10% in a week. And so it is subject to some volatility. So this is not entirely risk-free, by any means. But what I would say is that it's likely to be choppy and subject to that volatility over the near term. But I still think that over the longer term, it's probably a good place to have some kind of an allocation. Where we would have that allocation is within what we call our alternatives category. It holds investments that are neither stocks nor bonds, and it really serves to add additional diversification. In this case, diversification against things like the risk of inflation or geopolitical issues. And we currently do have an allocation to gold for our clients. It's not a gold specific fund, but it's a commodities fund. And so it owns various types of commodities, including gold and other precious metals like silver, in addition to things like oil and agricultural commodities or soft metals. So we do have an allocation to gold. I think that's really important to highlight, and we're likely to maintain that allocation for clients going forward.
Okay, so for clients, we're kind of going with a hold position with where we're at. So if clients then have additional questions about the decline in the dollar or the value of gold, what are the types of questions they should be asking their advisor?
Well, I think it all goes back to the financial plan, Breene. It's if clients are nervous about the decline in the dollar or the spike in gold and what that means and what that might mean for inflation expectations going forward? I think these are all great questions, and questions that they should be asking of their advisor, and how it impacts their financial plan. The beauty of the financial plan is that you can run different scenarios based on different return outcomes. And so it's a great way to kind of stress test the portfolio. If a client is looking at the spike in gold, and their takeaway is that this reflects fear about rising inflation expectations into the future, then they can account for those fears by building in higher inflation expectations into their financial plan and seeing if their financial plan still works. And so there's a lot of different ways to just work with those different scenarios. And I think that's a great conversation to be having with advisors right now.
Okay. So then it comes out into the asset allocation. Is that what you're saying?
That's exactly right. Yep. And as I said before, we do account for the declining dollar and the corresponding increase in the price of gold within our portfolios currently, and it's something that we're always mindful of. And I guess one other point that I didn't make before, Breene, that I think is noteworthy is that even though I think the dollar has gotten on the radar of many in the media and certainly many investors in the past several weeks. And the reason is because we've seen a significant move, 10%, in just a few months. But I think it's really important to step away from that short-term perspective and look at things going back several years. The spike in the dollar actually began, so the dollar has actually been appreciating versus other currencies since about 2014. And that's one of the reasons that US stocks have done so much better relative to their overseas counterparts in recent years. And so we're starting to see this reverse a little bit, but in no way has the dollar given up all or even the majority of its gains. The dollar is still up about more than 15% from where it began the rally in 2014. And if you look at it on another way of looking at it is on a trade weighted basis, meaning it's actually weighted based on the US's the amount of trade the US does with individual economies with their own currencies. And so the trade weighted index is actually still up about 25% from 2014 levels. And so we still have a ways to go. I wouldn't worry too much from the decline in the dollar, and quite frankly, I'd expect it to continue, but it's not something that one should necessarily fear, but just know how to manage around, and that's what we're doing within the portfolios.
Adam, you're a wealth of information. Even when we try to go to break, like you always add extra nuggets. So thank you so much. So we always like to add one little fun question. We've been having record-breaking heat. It has been sweltering all across Southern California and a lot of the West. How are you beating the heat? Or are you just sweating along with the rest of us?
Well, I had been sweating along with the rest of you until yesterday afternoon. We brought out the inflatable pool, and we have a little bouncy house with an attached water slide, and I joined the kids on that in the afternoon.
It got desperate.
It didn't start off that way. I made the mistake of walking outside and I got sprayed by my son. So, but it was all fun and certainly nice to cool off.
Okay, well that sounds great. All right, for all of our viewers and our clients, thank you so much for paying attention. If you want to continue to follow us, you can subscribe to our blog. You can also find us on YouTube, where you can subscribe to our YouTube channel. Thank you so much for joining, and we hope you have a great day.